The material we're covering here is important, not only for the exam purposes, but for the real-world applications of selling and servicing group insurance coverage. While there are many different types of groups that purchase insurance, the most prevalent by far are employer-employee groups. The employer is the sponsor of the plan, and the employees, which can include owners, are the insureds. Most group insurance is sold to larger employers. For the purpose of this course, the dividing line between small and large employer groups would be employers of more than 50 employees. Remember, these plans offer conversion for employees that leave the group. Florida has its own rules for continuation of coverage, as opposed to converting group coverage to an individual plan of insurance. We also talked about SHOP, the marketplace for individuals and small businesses looking for coverage and the potential tax credits for employers that use SHOP when buying coverage for their company. Remember, groups can't be formed just to buy group insurance. They must exist for other purposes. Group underwriting is also different from individual underwriting. Groups are underwritten as a whole, and the insurer looks at averages within the group, such as the average age and gender of the group. And the insurer also examines risk factors and levels of benefits offered. There is rarely any individual underwriting with group insureds. The Affordable Care Act altered the landscape with regard to pre-existing conditions. Now, it's difficult for insurers to attach an exclusion for medical conditions that existed prior to the policy being issued, or for a group member being covered. Dependents of group insurers are also typically allowed to enroll in group benefit plans under the same conditions for employees. Coordination of benefits provisions are specific to group insurance and come into play if an insured has more than one group contract that applies to a loss. The primary reason for the coordination of benefits provision is to eliminate double coverage or an insured profiting due to a loss. The actual policy issued in group insurance goes to the sponsor of the plan. It's called a master policy or contract. The insured members receive certificates of insurance instead. Contributory and non-contributory plans are detailed. This encompasses who pays the premium on group policies. Within these concepts are the participation requirements that require a certain percentage of the eligible employees to be enrolled in the plan. These requirements are enforced by the insurance companies, and if the enrollment percentages fall below a certain percentage, a group can actually lose its coverage. The Consolidated Omnibus Reconciliation Act, or COBRA, is a federal legislative act that provides group employees with the way to continue their group coverage after a separation from work. A few key things to remember are: COBRA only applies to employers with 20 or more employees, and it provides continuation of group insurance coverage. Remember, though, that the premium for the continuation is 100% of the group rate plus 2% administration, for a total of 102% of the group premium rate. While we're on COBRA, please study the continuation periods and what each of them applies to and the length of time coverage will continue.